Warren Buffett often references the book The Intelligent Investor by Benjamin Graham. And in Benjamin Graham's book, he talks about this notion that every day you go to the market and you try to make a deal with Mr. Market. You want to make a deal with him, though, when he's being irrational and he's giving you a tremendously bad deal. You go and you take advantage of Mr. Market and the deal he's trying to make. So I think at this point in time, it's safe to evaluate what Mr. Market has been doing and determine whether or not Mr. Market is actually giving us a bad deal. Now let's take a look at the S&P 500 year to date. You will see a very strong start to the year that tops out around February 2nd. That was a date of a Fed meeting, several earnings out of tech, and then you began to see the start of a downtrend. And this downtrend played out until Silicon Valley Bank failed, March 10th. Particularly in the QQQs, an area of the market that seems to be impenetrable, but clearly was last year, so we'll get to that later in the video. But that area and the whole market broadly, that includes the 10 stocks that contribute to the entire S&P 500 gain this year, saw a tremendous rally since SVB. Now, that would be justified if what the market expected to occur then actually occurred. When SVB happened, when that local low was put in, various things occurred. Lots of pricing of rate cuts, talking about Fed pauses, Fed eases, all these kinds of things. A whole paradigm shift, a reemergence of QE. They've gone too far. They're going to have to reverse. Inflation has been conquered. On and on and on. You get the idea here. However, I think Mr. Market, what might have been a fair deal with fair assumptions at that time, is now making a bad deal because we've taken that and we've gotten to a point where we've allowed price to dictate sentiment. And that is a very dangerous thing. When you see prices going up and you say, oh, it's a boom, and you decide to continue to go with the boom, or in this case, the market. I'm not saying you, the viewer specifically. I'm not talking to anybody in particular. I'm talking about the broad notion, the broad idea. When the market continues to move like that, it's simply getting dislocated from fundamentals. Now, let's get into the fundamentals. We just talked about the market action. We saw an initial burst to start the year. That burst turned down once the Fed had its meeting and earnings showed continued decline. They have continued to decline. Even though Q1 earnings were better than expected, they're still declining. S&P 500 earnings are declining. NASDAQ earnings are declining more. Even Apple earnings are declining. Anyways, we had a QE expectation, a Fed cut expectation. Not only has that not come to fruition, but it's actually gotten worse. The Fed has hiked twice since SVB, when many were expecting them just simply pause and not hike again. Clearly that's not the case. Additionally, they've talked about longer-term interest rates being higher than previously expected. There are several Fed members now talking about how they won't go to zero in the event of a future recession. So the real estate prices, assuming no printing of money that we saw in the past, should probably never return if interest rates aren't going to return back to the levels they were before. That's just what I assume. They're actively shredding money right now. So, we'll see what happens. Maybe velocity of money goes up, productivity expands, margins expand, and people want to rent more spaces. And that leads real estate prices to go up. I'm not sure, but I think all else equal, things are going to have to change. And I don't think it's going to be all else equal. Let's get back to the fundamental discussion. The idea of a Fed rate hike or not a rate hike is not a market catalyst in a vacuum. It's not like simply the Fed hikes rates and then all of a sudden that's it. That's the play. We're going to a horse race. We're just trying to bet or casino. Is it going to be red or is it going to be black? No, that's not what's going on here. What's going on here is the Fed is constricting oxygen to the economy. This is a very big deal because it rarely occurs. This is not a very popular thing. And the last two times it's happened, It's contributed. The most recent time was in end of 2018. They barely did anything. It was a strong everything, no inflation even, and the stock market fell some 20%. Yes, it did that last year, but this year's a totally different picture in my opinion. The time before that, great financial crisis. Now, I'm not saying that's going to happen, but I do think the excesses that were present that led to that situation might have occurred again. Just might. Just might. Just might. You see what's happening with FTX? Just might. Just might, people lending at zero interest rates because they can make fees on loans. Just might. I don't know. Just my opinion. We'll see what happens. It's clearly taken longer than I thought. Nobody's perfect, okay? I'm not trying to say I'm perfect and I know what's going to happen with certainty. What I'm trying to say is something just might happen. There just might be some parallels there. You have the head of JP Morgan bond allocation, I believe, or something like that, Bob Michel, if that's his name, saying parallels to 2008. So I'm not trying to be somebody crazy here. I'm just trying to go off of what I'm seeing, and I'm not the only one who thinks this. Now, there's a lot of people who don't think this. You're obviously seeing massive bullish sentiment in recent weeks. But back to the fundamentals. Higher interest rates, constricting oxygen to the economy. This is all done to bring demand down. As inflation has remained more sticky, as the economy in the arrears has remained more resilient, the Fed has had to go further with interest rates. This affects home values. This should affect stock values. This lowers or should lower household net worths. It should decrease borrowing. That should help bring demand down. When demand falls, you see earnings decline. Earnings have already begun to decline, but inflation has remained sticky in the eyes of the Fed and other central banks around the world. We hear that there's a lagged effect with interest rates. So don't think just because the economy has been strong so far, it's going to remain. I will say, I'm generally impressed with the strength of the economy. I would have thought a little bit more weakening by now, but I think the bulk of the weakening is going to come down the line, probably in the second half of this year. Obviously in the second half of this year, we're basically there at the minimum, and it's probably going to continue somewhat into 2024. So when Powell spoke in August of last year, and the market was making the same mistake it's been making all year, expecting a pivot, expecting a pause, saying the Fed's done enough, inflation's going to fall like a rock. Powell talked about, instead of delivering on that pivot, pain for households. Pain. That's what brought things down. The idea that he didn't pause, he didn't pivot, and then went further and directly confronted the notion that there will be some economic pain. And we haven't seen that yet. And clearly, even though they're going to probably pause this week, there's a lot of expectations and chatter, and they've even said they don't want to end the hiking cycle yet. And there's multiple Fed members who, or at least one, Kashkari, former Dove turned Hawk, pretty important guy for that reason and other reasons, but that reason was why he speaks the way he speaks when he speaks, and is famous, and has essentially been one of the leaders of the Fed because the Fed has just continued to move in the more hawkish direction, is saying pause, but also saying possibly 6%. So that was just a few weeks ago. Let's not pretend like the world changed. We've been here before. We've seen this happen many times before. That's all I'm trying to say. Bottom line is, I think Mr. Market is currently giving us a bad deal. I don't think the market is viable here, at least the broad indices. Maybe you can find something under the surface. I certainly have plenty of energy stocks under the surface. Some are even green today, like Petrobras, when oil is down 4%. That stock is tremendously cheap. It has its individual reasons why it's been cheap, and they've been short reasons, and those short reasons aren't coming to fruition. You might be able to find situations like that. I'm not saying don't buy anything, be 100% in cash. You probably should have some stocks. What I'm saying is there are many stocks that are very expensive, individual names, broad indices that I think are very expensive. I'm beginning to slowly add to some, or create some shorts again, and I think the market's going to reverse. So let's see what happens. That's today's video. And until next time, peace out.